welcome everybody. I appreciate you showing up. And this morning we kind of did a presentation, and the sun was that way, and it got really cold back here. So now it's nice and warm. But I appreciate everybody coming and seeing this beautiful property. We're excited about this property, so hopefully you can take a tour and see it to see similar to what PEG is doing with their new development projects in the multifamily space. I wanted to start first by talking a little bit about PEG and where PEG is positioned as a manager of these assets and your investments. As we've gone through this pandemic, one of the concerns that would definitely be out there, and I want to just to make sure everybody's comfortable with who we are, is look, are we positioned in a place because we have hotels and other real estate investments, or is PEG in a position to be able to manage your assets and be able to be stable as a company? And the answer is yes. We've been able to preserve cash as a company and be able to, we also were able to shift when the pandemic hit and be able to become more efficient with our people. And we had to do some of the hard things by laying people off and cutting salaries a little bit, so in order to get to where we're at. The other thing we were able to do, which I think is a huge benefit to investors, was at the beginning of the year, we rolled up all of our operating companies into one company, into PEG companies. We bought some of our partners out, and then we did some stock transactions with others. The reason we did that is to try to provide a better investment opportunity to our investors and us as a company, so we could control the assets a little bit better on the operating side. So perfect timing for us in one way, maybe not so perfect in another way because of the cost of doing it, but we were fortunate enough to have enough cash set aside to be able to do that and to make it through kind of the worst part of this pandemic. What that had done for us by rolling that up is it allowed us to shift at the property level and to be able to be more efficient and make the changes we needed to on the hospitality side to be able to be more profitable as we come through this pandemic, and be able to preserve cash when we just didn't have occupancy and revenue. And so we were able to do that. We have a better operating model that I think we'll use going forward as we continue to grow revenues, and as we come out of the pandemic in the hotels, we'll be able to operate at better margins and be able to provide a return back to the investors. So excited about that. We're also on the multifamily side. We brought a new hire in who has a lot of experience. Deborah I think she's around here. She's probably doing tours. Brings a lot of experience how to operate our hotels and or not our hotels, but our apartments, and to provide a better return and understand how to lease some of our new properties. And so that'll be a huge benefit to us going forward. And then on the hospitality side, Graydon Pearson, who's been in the industry all his life from when he was a kid, grew up in the industry, really brings that expertise of the hospitality piece to the company. And we're providing support to him from a standpoint of giving him resources, but letting him operate and treat our guests so they appreciate the properties and they feel like they have a good return for what they've done, as well as the investors that are investing in it. So as we also sat and contemplated where we're at, Rob Fetzer, our COO, and I actually made a point to start visiting these properties. As PEG did this transition and rolled everything up, we wanted to make sure all of our property managers at the actual properties that are running it, that are trying to produce the revenues and the NOI for the company, they understood what the vision is. And that vision for PEG is to try to be the best real estate investment company, and we do that through the operating of these properties and making the right investments. And so we truly believe that if the properties, the manager of the properties understand the vision and they understand why we have the property, that they can impact the bottom line. And so we try to empower them to run their properties. They know the properties, And if they see that vision and we can provide the support to them, they'll be much, much more effective and be able to drive to a return to the investors. So we've visited about 50% of our properties, and we'll continue to visit the other 50% before the end of the year to make sure each one of those property managers knows the vision of the company, so they can drive to that return and the stability of the property that Peg is really trying to push as a vision. So having said all that, going forward, we have some exciting things that we're working on in the spaces that we think we can not get hurt on an investment and long term. The first one is a family office club deal, which we're building new build developments in the multifamily space in the Intermountain West. And I'll talk a little bit about why we like the Intermountain West, and most of you understand this probably a little bit more because you're here. But the family office club, we sat and talked to a lot of our large families across the country. They just didn't want to go into funds on new development stuff. They wanted to pick and choose. But they also got tired of doing the big institutional investors like the Blackstones or the Colony or some of the bigger ones, because they wanted more visibility and they wanted longer term hold. They didn't want to exit quick. They wanted the cash flow in the apartment space. And they wanted to get in the Intermountain West. So we formed what we call a family office club, and we started with the parameters of having 5 to 6 large multi-million to billion-dollar families. We ended up right now with 4 families in that club. That club will be a GP in all of our new development deals. And they also have the first right to be the LP in them in the deals that we have. Right now there are 5 on the docket that we have, 1 in Tucson, 1 in Scottsdale, 2 in Salt Lake, and 1 in Boise. So what will happen is they'll get the club, which Peg will be a partner of, will be the GP, and then we'll have LP investment from the club members will have the first right to invest all that capital, and after that we will be able to go out and have other LPs come in. All but one of those projects are actually in an opportunity zone, which is there's some tax benefits for that, but you don't have to put capital gains in to invest in it, but it does allow for those that want to have a deferred tax structure to be in it. So one of the other thing that we've done, which you'll hear Soren talk about, is this extended stay strategy to kind of hedge against the declining hospitality returns, and then also providing affordable housing or workforce housing in the market as we start to see the economy shift a little bit. So really quick before I turn it over to Soren, one of the things that we look at is in the Intermountain West, as we look at the CAGR or the growth rate, economic growth rate in these markets, we're seeing the Intermountain West about a 2.2% historic growth rate versus the U.S. of about 1%. And then going forward, we're seeing about 1.8% growth versus about 0.8% growth. The other thing that's, I think, really important for us to, as we've looked at it, post-COVID, is 5 of the top 10 cities in the study that was put out that are the best positioned to come out of COVID, 5 of which we are doing projects in. So that's Boise, Idaho, Salt Lake City, Provo, Tucson, Arizona, and Denver, Colorado. So we would feel very confident we're in the right markets, and we want to continue to be in those markets as well. So, and that's just on our new multifamily development projects, not necessarily the extended stay stuff, because that's a strategy across the country. So having said all that, once again, I appreciate everybody coming and listening and looking at the opportunities that Peg has, and hopefully feeling comfortable that we're in a good position to continue to manage the assets in the funds that, if some of you have invested in the fund, we're in a position now that we have cash. We shouldn't have any need for capital calls. We're back to paying debt back, and we're positioned now to we hope, for the next 6 months, not knowing where we're at, make it through that without any problems or capital calls. And we're hoping, and our projections is to be back to distributions probably second quarter of 2021, which we're excited to see. So, Soren, I'm going to go ahead and turn the time over to you to talk about extended stay.
Okay, thanks, Cam. Hey, happy to be here. It's great to meet some new faces and to chat with you in this environment. I think some of you know that I live like 3 blocks away from here, and so does Jeff. And so during the entitlement process for this project, it was quite exciting. If you're members of the Church of Jesus Christ, you know how tightly knit and these congregations can get. And so rezoning this to multifamily in kind of middle of a residential neighborhood was quite exciting. But it just goes to show the things that PEG can do in difficult circumstances. I think it was a challenge to get this through, and it's turned out beautiful. We're really excited about it. So I get the chance to talk to you. I'm our Chief Investment Officer. I get the chance to talk with you about something that I dream about every night, whether good or bad. And it's mostly good, but I'm always, how you guys all do this, where you dream about things you're working on and you just can't ever get away from it. So I'm in on this every day, every night, and I appreciate the powers that be at PEG for helping me or allowing me to focus and put a lot of time into this strategy. It's a lot of fun. We see there's a lot of really interesting things in the market right now, especially where in the environment that we're in, that this fits really well into. It seems like as the environment continued from March through now, as it continued to get, I don't even know the word to explain it really, but where it's at, we see this conversion strategy of acquiring hotels and being able to convert them to multifamily. We see that strategy just continue to just be like a bright star for us. So let me talk to you a little bit about it. And most of you know this. I'm going to tell you a little bit of the history of how we kind of came up with this. About 2.5 years ago, we were in Boise. I was in Boise, and we started looking at. We obviously have a hotel in Boise. It was doing really well. It actually still is doing pretty well with this environment. But Boise is a great city. If you've been there, you like it. Got great personality. A lot of great things happening there. And so we were thinking, how can we get involved here more? So we looked at a bunch of properties, and we came upon a property that looked like an old apartment building in a great location, but it had a Residence Inn sign on it, right? And we looked at this property and this looks like a hotel. Or an apartment building. It's a bunch of separate buildings, 2-story walk-up, garden style. And there's a new hotel being built in, Residence Inn being built in downtown, not too far away. Why would Marriott do that? Why would they allow that? So we did some research, and we found out Marriott wants these old hotels out of the system. So we made an offer on that hotel. The seller said no, and they put a bunch of money into it to do an improvement plan on it and whatnot. But it taught us a lesson. And we went back to Marriott and said, hey, what more hotel? Would you have more of these in the United States? How do we capitalize on this? Because these are apartments. And if we can convert these hotels to apartments, that's us, right? We're hotel developers. We're apartment developers. We do renovation work all the time on hotels. We know what's going on. So Marriott gave us a ton of information. We started making a ton of phone calls to all the owners. And we came across a couple portfolios that Blackstone had that they were marketing. And we acquired those with the intent at that time to, and actually these hotels, because of the oldness and nature of that older building, that older style Marriott wanted out, they weren't renewing the flags. So sellers of these hotels were selling them at a higher cap rate or at a cheaper price than what a normal Residence Inn would be selling at because they weren't going to renew the flags. So we were buying these things at a discount, and we were like, wow, these things still have great cash flow. So they were cash flowing well. We acquired them, and we made an agreement with Marriott that we would find a new piece of ground, build a brand new Residence Inn, take the flag off the old one, put it on the new one, and then turn the old one into apartments, which meant we had to re-entitle the property. and understand the multifamily market and operate as apartments. So that's, those of you who are investors in Fund 1, that was the strategy with those 11 hotels that we acquired. And things were going well until COVID hit. They were cash flowing well. We were out looking for replacement properties. We were re-entitling properties. We had success on a handful of them, the ones that we were focusing on. So everything was going well. COVID hit. The properties in their relative markets are doing relatively well on a whole, just because of the nature of the extended stay type of product that they were and how those have transitioned through COVID. So that strategy, was so exciting back then. We had so much energy around it that we decided approximately about a year ago, we just got to do a strategy fully focused on extended stay hotels. So we internally, we prepared for it. In January and February of this year, we were moving forward, putting all the processes in place and doing all the underwritings, getting the models correct. And we were looking at a couple really good portfolios, and then COVID hits. And at first we're like, everybody's at a standstill. And that we were able to morph that extended stay strategy into something that really works right now. So because of the environment, lenders aren't willing to lend on a hotel, right? You can imagine trying to buy a hotel right now and have a lender feel comfortable lending on a hotel just doesn't exist. However, for us and our situation, there is a plan, right? We can turn a hotel into a multifamily property. And what we do with that, and just so you all know, we are looking for extended stay hotels that have kitchens in them, right? Whether it's a kitchenette or a full kitchen, and it's the intended purpose of these hotels were to keep people almost as a short-term apartment resident, right, for a handful of weeks, and that someone could sustain themselves. They could go grocery shopping, they come in, they could cook, and they could live at a hotel for a longer period of time than just a regular select service hotel like a Courtyard or something. So we are looking for these hotels that you can convert, that basically look and feel like apartments and re-entitled to convert to multifamily. And I'm going to talk a little bit about more why that's cool. So in this current environment where lenders are not lending on hotels, we are finding that even though it is still difficult, that we are finding they're a little bit more willing to lend on apartment buildings that are a hotel that's zoned properly and can get leased up as an apartment building. They see vitality in that. And now you take a step back and let's look at the big picture of this. What does this do to the economy? Why are we excited about this in an economic situation? And go back to Fund 1, where we had 11 of these hotels. Why? Not just because we're multifamily or hospitality developers and operators, but we also began to see this push, and you guys have seen it, towards the affordable housing in this nation, how there continues to be that gap. And cities are frantically, not all cities, but a lot of cities, are frantically trying to find workforce housing, attainable housing for the teachers, for the policemen, for those type of individuals in those workforces. So if you saw our webinar, you saw that there was an individual from the city of Buckhead, and Buckhead was in Atlanta. Now, Atlanta was a property where we acquired the property at a great price. Properties at great locations, cash flowing well as a residence in. And when we went into this property, the city said to us, "Oh, it's going to be really hard to entitle this because the zoning, whatever it was, the land use attorney said it's going to be really hard." But we said, "Well, we have confidence in the future. We're gonna perform it to be a long-term hold, and we're going to see what happens. Love the location, love the opportunity, just feels right." And a year after we bought it, the city came to us. Actually, the land use attorney came to us and said, "Hey, the city wants apartments. They want Class B apartments. There's this big push to get affordable housing in the city of Buckhead. They don't know how to do it, and you guys have an answer." So we went and met with the city, met with the land use attorney, and they loved it. They loved the idea. We got it passed through quickly, and boom, now we have the zoning for this property. There's some other nuances, and we're working at the potential ability of being able to convert that early and what that means on a financial basis and whatnot. But this movement is continuing to be seen in today's world. So a lot of times we go in and talk with cities, and they don't really quite understand what we're doing. But when we start to explain to them and say, look, and listen, this is an opportunity for you to get Class B housing. You see all this Class A stuff being built, which is great. Locations, cities need it. But they're building so much Class A that we're missing out on the Class B. The Class B numbers as a percentage are diminishing. And so when we talk to them about how this works, and I'll tell you how it works. So most of these properties that we're acquiring on a square footage basis per door are a little bit less than this type of product you're seeing. So here you have a one bedroom, 1 bathroom apartment that is 700 square feet. A 1 bedroom, 1 bathroom apartment in an extended stay property, a hotel, is typically around 550 square feet, maybe 600 square feet. So it's not technically what you're seeing in comparable in this marketplace to the product you're seeing. So what we're doing is we're coming in and we're saying, okay, we recognize there's Class A product, but we're competing against the Class B product. And the Class B product might be a little bit bigger, so our rents aren't going to be able to be as high as the Class B product. But if we can come and slide in and have good finishes and have a really good feel, and have these properties have amenities as well. They have pools, they have barbecue areas, they have fire pits. Some of them have sports courts. So they really operate like an apartment property, but the units are a little bit smaller. Maybe some of them have a little bit higher percentage of studio units. We can fit the demand of somebody who's looking for an attainable workforce housing, not have to pay the higher rents that you're getting in Class A, obviously, and maybe even come in and slide in on a lower rent basis against the Class B market. So that's what we're looking at. When we go into a market and we see a product that comes to us, and it comes to us often because in this environment, there's hotel owners who say, I cannot sell this hotel. I need to sell it. I need to get out of it, but I can't sell it to a hotel buyer, hotel operator. We come to them with a solution. We can buy this property from you, most likely at a discount, but it's not going to be a complete fire sale that you're likely seeing if you're going to have to sell this to an all-cash hotel buyer. We can go get financing, but we need some extra time to do entitlements, and we want our PSA, a purchase and sale agreement, our closing to be contingent on that. So they say, okay, great. You guys get due diligence, go through the entitlement process, do what you need to do. So we get a little bit longer due diligence period. But we go in and we price against the market. We look at where current rents are in Class B. We look at where sales comps are on Class B product, renovated and unrenovated. So you're seeing property, Class B type of property in the market that's selling that is selling unrenovated. That just has the old school interior finishes. And you're seeing Class B product in the market that's selling renovated, that has the nicer finishes, the newer countertops, the newer cabinets, the newer flooring. It's still in a Class B older property shell, but they went in and renovated. So we look at both of those pricings. We also obviously look at the zoning. Can we get this thing zoned? Is it already zoned? Do we need to just get a parking variance? Do we need to get a use variance? How easy is it? We go talk to the cities. Do we need to go through planning commission? Do we need to go through city council? We do all that stuff. And we do that, anyway. So it really fits who we are. We look at those items. We look at the marketplace as well. Is this a market where we can find institutional buyers on an exit? Is this a tier 1, tier 2, tier 3 type of market where we're going to see potential transactions? And then we go through our due diligence process and our underwriting. So that's how we look at these properties. I'm trying to think, Rachel, what else do I need to talk about? I think I'm about done with talking the pipeline. Okay, so our fund, we're looking at $150 million is what we're raising on the equity side. We have a lot of interest on the big institutional investors. We've had a lot of interest all around. Right now we have 5 properties under contract. We're looking to close about 4 of them before year end, maybe 5. We have a pipeline of I think it's in the presentation there. There's several thousand of these things in the marketplace. We have a pipeline of probably, I think that's in your presentation as well, about 100. Obviously, we're going and stratifying all the properties we're looking at, seeing which ones are in the good markets, which ones have entitlements, and then we start peeling back the onion to make sure they're the assets that we want to acquire. Brands, we're buying We're looking at Marriott's, obviously, Hilton's, Hyatt's, IHG's. There's also other type of unbranded properties that are perfect for redevelopment. In fact, there's a property in Austin that's in a redevelopment location. We like the property. It looks like, feels like apartment building. It's extended stay. It almost feels like a Gen 1 residence in. We're really excited about that property. So we have properties under contract. We're moving forward. We have LOIs out right now. So we're growing our team. We're moving forward fast. I'll open up for questions. Does anybody have any questions on this? The last group was about half this size, but they had a ton of questions. And it was great. I was able to some of them had some questions about, the details.
Like, market comps and all-in costs and things like that.
Sure. Yeah. So Rachel, thanks for reminding me. So when we're looking at market comps and we're looking at all-in costs, again, like I mentioned to you, we're looking at the sales comps, the renovated and unrenovated values. When we acquire, the vanilla underwriting we do is with a renovated type of product that can compete with a Class B, a nicer Class B type of situation. So when we look at our all-in renovated comps, we hope to be about 15 to 20% below where the market is currently selling these things at. So we hope to have that cushion. We hope to be conservative in that sense. Our IRRs, we're looking at about on a gross basis, the high teens to low 20s. Our cash on cash we're looking to try to stay around that 10%, whether above or below, just depends on the location and the product. Well, it's other questions. Vivian, you always have great questions.
Well, my only question would be on
Okay.
the extended stay hotel. Why not wait? Will it get cheaper next year?
Yeah. So Vivian's question is, why not wait, right? These things are going to get cheaper. It's a good question. Why not wait, right? A lot of especially in the hotel side, if you're looking to buy hotels, specifically hotels on the extended stay, you can wait. What we're finding is there is a lot of competition in the market. Not that, that means anything. But we're finding that a lot of these values we're getting and on these assets that we're getting some really good assets in really good locations. And so when we do our underwriting, we underwrite these things as multifamily properties, really. Because if we can convert and get the zoning and entitlements before we close, we basically have a multifamily property. And so we're really technically looking again at the multifamily market. And so when we underwrite our multifamily market, we're trying to be conservative. And we say, okay, today, it's market by market, right? That's why we go tour markets. That's why we get Deborah out and we drag her along with us. And we say, okay, well, let's dissect this market, figure out where multifamily values are at. And we'll comp against those. We'll look at concessions. We'll say, hey, what was this pre-COVID? What is it now, COVID? Right? How far have market rents come down? Have they come down? In our valley here, market rents to a large extent on our properties, at least our Class A's, haven't come down, but they're offering concessions. So we look at the markets and we say, okay, this is pre-COVID market was like this, post-COVID is here. Are we underwriting? Maybe we're underwriting a little bit here with concessions for a year or two. So we take that into consideration and hope that we're conservative in that sense. So will there be more assets that come about? We do believe that. In the next couple of quarters, we think that there is going to be. However, right now, we also think we have a pretty good first movers advantage. We're seeing groups step into this and offering on every property that we're offering now. So competition on the offering is a little bit stiffer. We mentioned on a call the other day that this is really interesting, actually. We have a Gen 1 residence in St. Louis that was part of our first transaction with Blackstone. We got it at such a good discount that we just said, hey, let's hold this thing as a Marriott property. We were getting great cash flows as a Marriott property. And at this location in St. Louis, the multifamily market was depressed. We didn't think we would have good enough values to exit as a multifamily product. So we're going to bleed this thing as a Marriott and just get great cash flows as long as we can. Well, COVID's hit, and there's other groups coming into the marketplace right now. A group approached us the other day, and we're working on a contract with them. They approached us with a valuation on a multifamily side that's a lot higher than what we valued it at after converting it ourselves, after going through the entitlements ourselves, after like 10 years of hold. The valuation that they have given it on the multifamily side is higher than what we thought. So we're like, oh my goodness, these guys are really aggressive. Let's not tell them about our analysis, but let's get under contract and try to get some teeth in there to keep them in there. They're also a 1031 buyer. So there's a little bit more aggression there. But we're seeing this happen in the marketplace. That what we're doing is not unique, but from what we've talked to with these larger institutional investors, a lot of these groups are interested in us because they say PEG's been working on this for 2.5 years. They have the processes in place. They're hospitality, multifamily. They understand both markets. They understand renovation, and so that's why we have a bunch of these groups knocking on our doors. Sorry, that was a long answer. Any other questions? Yeah, Nate.
I mean, it's kind of related to what you talked about. So is the price increasing with increased demand by buyers, or is it decreasing based on the economy? I mean, from your previous acquisitions.
Yeah, so the question is, like, compared to our previous acquisitions in like the earlier funds, probably. Yeah, we seeing pricing increasing or decreasing? I would say it's decreasing. Pricing is decreasing a little bit, just because you're seeing that these are distressed values that we're purchasing at, just because of the environment. And again, like I mentioned earlier, there's nervousness on the hotel ownership side that if they're in trouble for whatever way it is, most of the assets that we're looking at acquiring or we have under contract, we're basically in at their debt value, right? Or maybe it's subpar, or there's distress on every single one of these. So these prices we're seeing have come down. So we are seeing valuations come down lower than what they were previously. But also, we're having to deal with, on the other side, we're having to deal with brands and liquidated damages on trying to pull the flag off. That's happening a little bit, but we're actually able to go negotiate with the brands now, whereas before the brands they didn't want to negotiate these kind of things, but now they are negotiating. And so that's what we're actually working on with the current portfolio. We're looking at maybe an early exit, and if we have an early exit, can we pull that flag off and have a limited liquidated damage fee as what's in our contract? So, yeah, Rich.
What's the obligation with the Marriott and Hilton World building new properties? If you pull the flag off of these old properties, are you obligated to build a new hotel?
Yeah, we're not. So if we go in and, like, there's a property right now that has 2 years left on the flag, Marriott flag, that we have under contract and that we'd like to close on before year end. They would obviously like us to, right? They said, oh, well, hey, how about you don't have to pay the liquidated damage fee if you build a new property in this location. So we, look at that as well. But there's no contractual obligation other than having to potentially pay a liquidated damage fee. But again, those things we're negotiating, and we put those fees into our model. And then we'll say, is this a market we want to be in right now? Do we want to buy another property? Right now, we're not looking at buying other properties in the locations that we're at, right? That we're looking in right now. So, for example, Sacramento is a great property, great residence in Gen 1 that we acquired in Fund 1. We had a property under contract. We had it designed. We were getting ready to try to. We're getting ready to bid out and actually close on the ground. COVID hit. The seller put the transaction off for a year, so we're putting the whole thing off, pushing it a year, seeing how the environment shapes up, and we'll revisit at that time. So we have a contract with Marriott on that we don't have to pay the franchise fee if we take the flag off and everything. So the Marriott's honoring that. Anyone else? Yes.
So when did PEG start, and was it before 2008, 2010? I just don't know the history.
The history of PEG?
Yeah, well, have you gone through this kind of cycle?
Yeah, good question. Maybe Cameron can talk more about that. PEG started in 2003. I can tell you from watching them. I knew PEG in 2006. I didn't come to PEG until 2012. In 2003, Cameron started it. He was like 19 years old. I got brownie points for that. 2003, he and Rob started the company, and this was my story about PEG. This is my take, and they did a lot of everything. They were out developing as much as they could, and then come 2008, the downturn hit. PEG actually found great partners, a guy named Reed Halliday and a guy named Mark Bingham. Those two were great investor owners, believed in PEG, and helped carry PEG through the downturn in the sense of were great partners, great supporters. PEG didn't lose any properties during the downturn. And they had to work out a few, but had to rebalance loans and whatever it might be. But the partners stepped up. And I was watching this from afar. I was in business school 2008 through 2010. That was a good time to be in business school, right? And I just continued to watch PEG grow. And they came out of the downturn. It had a lot of opportunity, a lot of support from the partners. A lot of focus started hitting Utah at that time. Goldman Sachs came into downtown Salt Lake. When that hit, that was like all the coastal markets were like, Utah, where's Utah? And then Goldman Sachs is in Salt Lake City, like Salt Lake City, Olympics. Okay, this is a place. And I came to PEG in 2012, and we had nine or 10 employees at the time. We just had a lot of great support from our partners, and then we've continued to grow. Now we've got a lot more employees. So yeah, they went through that last downturn. Is that a good enough story? All right. Okay, yeah.
Since I'm not, how are the structures again? So what's the management fee? What's your general structure? 2 and 20? Or I'm just not. What are your?
Yeah, Rachel, do you want to come on over and talk about the structure of the fund?
So we're raising $150 million through the fund. It's a 8-year fund with 2 1-year extensions. As Soren mentioned, right now we have everything pro forma at a 7-year hold, but we anticipate to maximize IRR that might be like 3 or 4 years potentially. We'll see depending on how this goes. Let's see here. It's we've stated it as $1 million minimum investment, and that's just because we're limited to 99 LPs through the fund. But as Soren also mentioned, we have very strong institutional interest, which is giving us a lot of good capital up front. So I do think I can, work with people on that. So if folks want to talk about that, we can certainly go through that. But I am limited to 99 LPs, which is why I need $1 million minimum if I can. And let's see, it's an 80-20 split with the LPs. So it's an 8% preferred return, 80-20 split. We do have a 50-50 catch-up, and it's a 1.75% management fee. It's a 4-year investment period. So I can certainly send you some more info on that. This was our #1 strategy last year, and it's even more compelling this year because of where hospitality is at. And as I mentioned, we did an initial webinar back in June, I think, when we first launched on June 16th. And I can't tell you the number of calls we had and because of COVID, no one's traveling, so I probably have 40 meetings a week. And these are pension funds, foundations, some large groups. And so as I mentioned, institutional investors, the first time I've had some really good traction with some of these larger groups. And as soon as we pen the deal, we can make it public, but there is a very large group that will likely be putting a large cash infusion in, and that will really help. So any other questions on that? You should have some FOMO. Our first closing is this month, so FOMO if you're missing out.
So how many properties will be in this fund? What is it?
How many properties think 20?
Yeah, our goal is about 30. It's about a 4-year investment period, 3 to 4 year investment period. So we're hoping to get around that 30 mark. Some of these institutional investors would like us to have even more, so we're looking at trying to do
We
as.
technically can go to $300 million, but we anticipate this first time around will be at 150.
Yeah, Rachel said we technically can get to 300 million, we think, but 150.
But you have 11 of those properties secured. 11 out of the 30.
So the 11 were part of the first fund.
Okay.
So we have 5 right now under contract already. We have LOIs out for another 4. I could show you our spreadsheet. Makes my head spin a little bit of what's in our pipeline. So it's kind of exciting.
How are those converting from Fund 1 to this fund? Are they being bought at purchase price? Or being bought?
So how are they? Sorry, how are they converting?
Yeah, from Fund 1 to this fund.
Okay.
They're not.
Yeah, so Fund 1, yeah. So the question is, how are they converting from Fund 1 to this fund? All those assets are staying in Fund 1, and they're separate. And so those have business plans and strategies for each of those assets. And now we're having a separate fund that contains the separate assets that have their own strategy. And the main difference is, for right now, with the environment, we're trying to get all of the entitlements before we close. So when we close on an asset and we get financing, it'll be a multifamily property, zoned, approved. The city will say, yeah, that's a multifamily asset now.
You're not buying any of the funds from Fund 1.
So we're not buying any of the ones from Fund 1. Not currently, not yet. I mean, we were thinking, looking into that.
Fund one investors, we have to figure out.
Yeah. Great. Any other questions? All right.